In 35 years of helping people who believed they were adequately prepared for their financial retirement, there is nothing that I have seen that has been more disappointing, more disruptive than the Internal Revenue Service. And it's not by design. You have the rules, it's just most people don't understand the rules. The bottom line is your tax marginal bracket rarely goes down when you separate the workforce because you don't want your standard of living to go down. You're trying to maintain that. Understanding the tax code is critical. If you want to know more, you can go to fegtaxpack.com or call 833-TAXPACK. Get on our list. We will send you tax planning strategies that will help you navigate this crazy and changing world. Again, it's 833-TAXPACK, P-A-C-K, or fegtaxpack.com. Hi, I'm Joe Clark. Welcome back to your Retirement Playbook. Hope you're having an outstanding day. Hey, you're going to get tired of hearing this, but the bottom line, most decisions that we have to make financially, somehow or another, the IRS is included. It's like having a very small chair at the table when we're younger and a kid and we're growing up. The IRS isn't real involved. I found a sheet of paper not too long ago. I got audited in 1988 on Halloween. Really thought it was a joke. And the audit was for over $3,000 worth of income, meaning that I owed like $300. And I remember the crisis in my life. Talk about a little chair compared to where we are today in the world of the things that I get to deal with running a company. The point is this. Over a period of time, as our retirement grows, that chair continues to grow. The IRS gets a bigger and bigger chair at the seat of the table. And what you're trying to do as you build your financial journey is make decisions that keep that chair contained. Put them in the corner. Yes, we need bridges and we need armies and we need social safety nets. I get it. Not even trying to have that argument. The point being that I don't want the IRS being the driver of the majority of decisions that I have. Well, I'm often asked the question. I have two daughters and a church that I love. And charities that Barb and I support. And I'm often asked, Joe, when is the best time? When is the ideal time for me to make a gift? And that's a great question. Now, I'm going to draw on the whiteboard. Remember, if you're listening to this on the radio or the podcast, you can always go to our YouTube channel, Your Retirement Playbook, and see this and see the board. If not, I apologize. I will talk to you as I draw, but it's a matter of trying to put this together. So when we look at the theme of this show, the whole 4 parts, if you've missed that, remember it's the beginning, middle, and end of a retirement. For us, that's the accumulation phase, the preservation phase, and the distribution phase. They're all 3 different. Taxes are involved in all 3 of those scenarios. But when we talk about tax, we're talking about building tax diversification. If you did this correctly, and again, there'll be no beating on yesterday. Right? It does you no good. It does me no good. If wishes and wants and, all the things my football coach used to tell me, if you didn't work out hard enough, whatever, it can't go backwards. So some of you are in an age where you didn't have access to Roths. Some of you are in an age where you're just saying, why didn't anybody tell me? It doesn't matter. We are here. Wherever you are today, you can begin to build tax diversification tomorrow. Right? So tax diversification means that you're going to have some money that is tax deferred. Tax deferred is that money that your employer puts into your 401k, your 403b, your retirement, or if you use deductible IRAs along the way. Taxable is money that you've put into accounts. Think about your bank account. Once upon a time, you used to earn interest. Remember those days? You'd earn interest. You get a 1099 and you had to pay taxes on it. If you have a brokerage account that's a trust account or something like that, that is exposed to interest, dividends, and capital gains every year, that's what we call taxable money. And you're building a basis in that, by the way, of stuff that you've already paid taxes on, but it's taxable. And then you have tax-free money. Ideally, in a perfect world, somebody retires, they say, Joe, what percentage should be where? In a perfect world, right now, it's probably 30-30-30. And you've got that extra 10% flux on one side or the other for things you can't control over age. As we progress, clearly the best column is tax-free. The next best column is taxable, and the worst is tax deferred. Why is that? Because the IRS's chair is much closer to the table on the IRA 401ks than it is on the Roth, where they're pretty much out of the equation while you're alive. There's no required minimum distributions, etc. And on the taxable side, the IRS is only there when you make a decision. And you really need to think about that. When you make a decision from the money that's in the taxable side, it's like the IRS pulls the chair up to the table to see what you're going to do. And they're going to give you a series of rules. They just don't give you any wisdom. They're going to tell you that this is what will tax you on it, but they're not going to give you any wisdom as to whether or not that is a good idea, right? And so then once you've made that decision, they'll scoot the chair back. So in tax deferred, the chair's at the table. In taxable, it's there based on the decision. In tax-free, honestly, it's absent. It's missing. If you've got a Roth 401k, you'll have to take required minimum distributions. It's one of the reasons I would roll it to a Roth IRA. You don't have to take RMDs out of it. So those are the three areas. So let's say we have Apple stock. I love Apple. I'm long Apple. I love what Jobs did. I think Cook's doing a good job. That's not an endorsement to tell you to buy, sell, keep, or buy Apple products even. It's just one of those stocks that we've owned since 2006. We've had it for a long, long time. And our basis in the stock is very low. It is about $9 a share. Now, I've got to do all this SEC stuff since I've done this. Past performance is not indicative of future results. The prices are based on where they are today. It's not a recommendation to buy or sell. I am personally, I don't own anything that my families don't own. My portfolios are not allowed to be adjusted. So my 401k is what everybody else's 401k is that we take care of. My Roth IRAs or what my trust account or what everybody else's are. And that's the way I like it. I think it's ethical to be able to do it that way. So we have Apple, right? And people like to talk about the stock, about what it is they own. And that's a great thing. You can get focused on this. When markets are particularly volatile, people become much more interested in the individual components of what's going on. But we need to start with a bigger question, and that's where I always start people with their financial vision, part of our trademarked process when they're in the office. Where is it you're trying to go? What is it you're trying to accomplish? When I go work out, what is it I'm trying to accomplish? And I have a hard time showing up and working at it hard when I don't have a definite goal or objective of what I'm trying to get there. For those of you that are adequate or better golfers, you'll understand the same thing. I don't just show up on Saturday mornings and just try to play. I know what I'm trying to score on each hole as I go in, and inevitably I play better when I have that pre-planning in place. So Apple's a wonderful holding. First question is, what is it I'm trying to accomplish? Well, in this case, the question was not what I'm trying to accomplish, but Joe, I want to make a gift of $15,000 to one of our family members. Now, that gift of $15,000 is important. It was in the past because of the annual exclusion, the amount you're able to give away to a family member, assuming there's no strings are attached. And it's not just a family member, by the way. It's to anyone. The $15,000 has changed. It was $14,000. It was $10,000 for years and years and years. But truly, under the tax code we live in today, for the majority of America, it's immaterial the amount because you've got a federal unified credit of over $11 million of money that you can give away today if you wanted to without you or the recipient recognizing any income tax today. So it really is a moot point. So I know the number's off, but we're going to use last year's numbers of $15,000. You want to give your kids $15,000. Great. Second question then is, Joe, what's the best way to do it? Well, in this case, you can give them $15,000 worth of cash, right? You can give them $15,000 of cash. Again, you're not going to pay any taxes. They're not going to pay any taxes. But you could also give them $15,000 worth of Apple stock. Now, let's go to our three areas of where we put the money. Can you own Apple inside of an IRA or a 401k? Yes. Can you own Apple here in a taxable? Yes. Tax-free? Yes. Again, People make the mistake of not understanding the tax obligation is different than the investment itself. That's why you always go to the fiduciary focus, right? Risk and volatility. The risk and volatility of Apple is the same regardless of how you own it. The fees and expenses should be the same regardless of how you own it, though every now and then somebody's in a 401k insurance plan that has exorbitant fees that they aren't even aware of. And that's a conversation that we need to have. Fees and expenses. The third is taxes today and tomorrow. Does the tax consequence of Apple change in these three areas? And the answer to that is you can bet your sweet pippy it does. And four, last but not least, is the real return inflation. Is the inflation dependent upon these three? And the answer is not really, other than in my mind, tax rates do indeed inflate. They can go up. So remember, in the IRA, the IRS is constantly at the table. Whatever you do, they're going to find out about. In the taxable account, they only come up when you make decisions. In the tax-free, they pretty much leave you alone. Can you give Apple shares to your kids? And the answer is yes. Can you give it to them out of an IRA? The answer is no. The stock would have to be sold. You would pay taxes, possibly a penalty based on your age, and they would get cash. Same in existence out of a Roth. You can transfer these two, your IRA 401k and your Roth IRAs, you can transfer them to your kids at death. You can transfer them to your spouse if they became an ex-spouse and the court so ordered it. But other than that, you have to die to make the transfer. This is the area where you can make the gift. And when you make the gift, two things to understand. Is it better to give during life or give during death? If you give during life, their tax basis is going to maintain or remain what your tax basis is. So in this case, we've now paid $9 a share for the Apple stock we own because of all of the splits that have occurred since 2006. If we give that to somebody during life, their tax basis is $9 a share. So if they sell it, they have to pay taxes on anything between the $9 and whatever the current value happens to be. On the other hand, if I give that to them during death, based on the current tax code of 2022, they get a step up in basis. So their basis would become fair market value of whatever it is today, and they would owe no taxes at all on the selling of the stock. The key thing here is really understanding the tax code. And remember, there are two rules. It's not one for the rich and one for the poor. With the tax code, it's one for the informed and one for the uninformed. And right now is one of the greatest times in history to transfer assets to another generation, both for income tax purposes and estate tax purposes, especially if their tax bracket happens to be lower than yours. Do not forget to build tax diversification and always begin with the end in mind.